We got a little less than 8 minutes. Stocks are in okay shape here. A nice recovery after it looked like things could have gotten ugly this morning. A lot of risk assets were under pressure. Joining me, Collin Martin, the director and fixed income strategist at the Schwab Center for Financial Research, and Ann Sonders is the chief investment strategist. Great to have you guys here this afternoon. Ann, we had our first kind of like test, of this highly concentrated rally. How'd we hold up?
Yeah, so I think it shows you that there's still money looking to come in and any sign of a dip. But I think the bigger picture, to use the name of our show, and more important story is the continued rotation that's happening under the surface. I think, at the index level, even on resilient days, it doesn't really tell you the full story. You've got to go underneath the index and see some of these really significant rotations amid a lot of churn, and just the breakout that's happening at the sector level in terms of moving averages in areas like energy and financials and basic materials. And I think that's a sign of the resilience of the economy because of that cyclical bias to what is performing well.
Yeah, the market here has been able to find some hideouts, even like I noticed a few of these days where NVIDIA slows down, Apple kind of picks up the pace. We've got enough. Our game of musical chairs, at least we've got enough chairs still, even if the music's kind of quieted down a little bit. Collin, how about bonds? It looked like maybe this morning they were getting a bid because of risk off, but the bid just extended while stocks came back. So are we like feeling maybe a dovish Fed tomorrow or something?
No, I don't think so. I think it was really two reasons. The first was likely the Bank of Japan, who hiked rates, but was still somehow dovish about how they did it. So even though they're no longer in negative territory, they basically said, let's rein in expectations a little bit. It's not like this is the start of a long-term hiking cycle. So that led to Japanese yields moving down a little bit lower, and that pulled U.S. yields lower as well. I wouldn't expect a dovish theme tomorrow. If anything, the markets probably aren't priced in for a potential upward revision for the year-end dot plot. I think that's what we're going to be focusing on most. We're not expecting any change in policy, but because this is the meeting where we get updated projections, we're looking to see what the year-end projection is for the Fed funds rate. Coming into the year, as of last December, the median projection was 3 cuts this year, and there's some speculation, a possibility that could be revised to just 2 cuts. Mm-hmm. The bar is somewhat high. We need to see 2 officials do that. But given that right now, meaning today and as we approach the close, the market expectations are for 3 cuts. So if that were to change, we got a revision tomorrow where they raise their year-end rate, that could pull up yields a little bit tomorrow because I don't think the market's necessarily priced for that.
Okay. And as we kind of joked last time, if, we know it's going to at least stay at 3 or maybe move to 2. If it goes to 4, then there's going to be outrage. Riots in the streets was, I think, my joke. Ann, how does that connect to the stock situation where cyclical kind of breadth is trying to wake up? If the Fed gets more hawkish, that's usually not great for those sectors, is it?
Well, I think it's not so much at the sector level that you're seeing a tight correlation in an inverse way between yields and stock market behavior. Of course, last year, the S&P just at the index level was almost perfectly negatively correlated to yields. It explained the correction in stocks from late July to late October because of the spike in yields, and vice versa once yields started to come down. But now if you look at correlations, there's less clarity on the correlation at the index level to an index like the S&P or even the NASDAQ. But where you are still seeing a pretty tight negative correlation is down the cap spectrum. So that's where there is that sort of leverage on the downside, but risk on the upside in terms of yields is down the cap spectrum into the less well-capitalized companies, capturing the zombie type companies. So I think that's where you're seeing movement within the market tied to these moves in yields. You wouldn't necessarily pick it up by just looking at the index level of say, the S&P.
Okay. All right. Now, when we look at the big potential here for surprise, Collin, it seems like then our surprise would be like a big recessionary event that causes the Fed to skew super hard to the downside. It seems like most of our conversation, if we kind of go like 1/3, 2/3, 2/3 of it is generally like a stable to maybe kind of reflating category.
Well, if we're looking at surprises right now, and as we look at the next meeting or two, I'd say a surprise to the downside in terms of Fed funds rate, meaning a downside surprise to the economy. That's really not our expectation, and that would be such a shift relative to what we're seeing right now that I think if we're looking at two outcomes here in terms of hawkish or dovish, I think the theme has to lean hawkish. And the Fed will discuss the idea of being patient and taking a thoughtful and gradual approach to the potential rate cuts because we're not even there just yet. So as you mentioned before, are we looking at a revision to two cuts this year or four? The idea of four, I'd say that's not even being tossed around right now. And as it stands, the economy still continues to move along. And the Fed wants to see how its aggressive pace of rate hikes are feeding into the overall economy. We've seen parts of it slow down, as Lizanne talks about a lot. We're seeing these rolling recessions, but a good part of the economy is still holding up relatively well. So when you think about the idea of a recession and what will that do to Fed policy, as it stands in the here and now, and as it relates to tomorrow's meeting and even next month's, that's not really something that's on our radar right now.
Okay. Hey, Lizanne, kind of a big question for less than a minute, but I wanted to get a quick thought from you on kind of the symbolic nature of the end of the ZIRP period, or negative, I should say, technically not ZIRP.
I think that's what was notable about the move by Japan. It was less on the magnitude and what it might mean for their economy or their inflation data, but I think there is that end of that era, and there's a psychological component to it. And I think the general realization now across the globe among central banks is that hopefully that era stays in the rearview mirror, because there were arguably as many negative consequences of being either in ZIRP or NIRP as there were positive.
All right, thanks so much. Great stuff, guys. Really good making the connection here across bonds to equities. Ann Sonders and Collin Martin.